Hello, everyone. I hope you can all hear me. We'll be starting very shortly. I'm just waiting for a few others to join. I do know it's half term at the moment. I do apologise for organising a webinar during half term, but I'm very happy you could join us today. We are at the prestigious HSB office down in Canary Wharf. So very lucky to be here today, and also on a wonderful day for weather-wise as well. We are on the 42nd floor, so we've got a wonderful view of London currently. It looks absolutely amazing. I'm joined by some very special guests today. Hussein, if you could give him a little bit of a wave, that'd be great. So Hussein's joining us today as a sort of guest speaker on our sort of Q2 webinar for the year. He's a director at HSBC investment strategy team. And today we're going to be talking a little about global markets, a little bit about binary capital as well. Obviously, some of you already know Safdar Sarwar is our Chief Investment Officer at Binary Capital. He's going to be taking you over a little bit about Binary Capital's views on global markets, a little bit about the MPS, and we'll touch on, obviously, towards the end on the Q&A. But I'm going to kick it off today with a brief introduction into, obviously, Binary Capital and what we've been up to. It's been a really strange sort of first 6 months of the year. A lot going on, within the US, the UK, emerging markets, and we've got a lot to talk about. And I'm sure you'll have some really die-hard questions that you want to ask us. So please remember, there is a Q&A section at the top. I encourage you to ask as many of the hard questions as possible. We've got the right people here today to discuss and give you strong answers to those questions. So please, as we progress through the webinar today, do that. So without further ado, I will sort of kick it off, and I don't want to waste too much time if we move on to the second part of the webinar. So to give an introduction, you've seen the title, Return of the Bear Market. It sounds quite pessimistic. It isn't. It's just a question. We're very much stating a question here of what is the second half of 2024 going to look like? And we have our views, and we very much want to discuss those today, where we think global markets will go, where the opportunities lie for client returns, as well as opportunities outside of the US, the UK, and other asset classes. So what we're going to do is I'm going to hand it over to these two guys in a minute, and we're going to have a sort of panel discussion. We're going to ask them a few questions. They're going to go back and forth, hopefully have a few arguments in there, a few counter arguments. I think that's always healthy discussion. And then I'm going to hand it over to Safdar, who's going to take you over our approach to multi-asset investing and a little bit update on performance and our positioning for the second half of the year. Okay, so for those that don't know Binary Capital, we are a DFM, an MPS providing solution service for financial advisors across the UK. We are coming up to our 6th birthday today, more or less this year, sorry, which is a huge achievement for everyone here at the team. As some of you know, we do like to keep it quite small and tight-knit as a company, very, very boutique in our nature of investing as well. And we're very proud to be where we are today, to provide excellent, investment solutions for advisors, as well as client services, and to work with many of you here that have joined the webinar. So next point, what we're going to do is I'm going to sort of ask these guys a few questions, as I stated, and then we'll sort of move on from then. I do need to note that towards the end of the webinar, we do offer CPD certificates. So anyone after the webinar, please reach out to myself or anyone on the sales team at Binary Capital, and we can send those over to you. Okay, the interesting part. So I think how I'm going to start this off is if I sort of direct questions at both of you, and we can sort of have a discussion of where we want the sort of points to go. So if I start off with you, Hussein, if that's okay. So obviously there's been big talk on the US being the biggest opportunity, we think, in global markets at the moment. Do you think that is the only opportunity for client returns at the moment?
Yeah, no, good question. The US is a good opportunity, given what's going on with the enthusiasm amongst investors around the AI theme. I mean, the big tech names, the Magnificent Seven, as they're known collectively, are doing very well in terms of their recent earnings reports. They're providing quite good guidance. Some of that is AI related, but it does seem to be momentum there in terms of their performance, and we do expect that to continue in the near term. But at the same time, we are slightly cautious on the US market because of valuations, and we can talk about that in a bit. But in terms of ex-US opportunities, I mean, the issue we're facing right now as investors is the fact that so many risky asset classes have done blindingly well over the last 12 to 18 months. So in an environment where kind of cash rates or the risk-free rate is high, given what central banks have done over the last couple of years, then that kind of risk premium, which is the compensation for being invested in risky asset classes like equities or credits, has been significantly compressed. It's not particularly generous by historical standards.
Yeah.
So as you say, as you imply in your question, it is not obvious where you can get, good returns in the market. But we see opportunities. I mean, in DM, Japan is one for us. We've been talking about Japan positively for a while. There's a really interesting kind of investor story around what the government is trying to do to unlock value in the Japanese market, which for, I don't know what it is, 30 to 40 years has been doing nothing since the late 80s bust. They're trying to turn that around with corporate governance reforms. As I say, the market's quite cheap. The yen has been weakening, which is kind of an interesting story in terms of how that feeds into inflation and BOJ normalization, but also it's good news for exporters. So Japan is a market we like in the DM space. In EM overall, we see very good opportunities. Broadly better than what we see in DM, especially Asia, where growth is stronger. The Chinese economy seems to be on a more stable footing this year relative to last. We've got an upswing in the semiconductor cycle, which helps markets like Korea, Taiwan. So I mean, there is a good story there of kind of policy support, better value, stronger growth, and lower inflation, which we like. And then in fixed income, basically, we are still arguing for potentially good returns in the government bond space. If central banks are able to cut rates later this year, inflation continues to fall, then there is scope for capital gains in the government bond market. And within that kind of fixed income, high quality space, investment grade credit as well, where you can still get a bit of a extra kind of income from the credit risk component, and that for us is also a good opportunity.
So what you're saying is that there are other opportunities out there than the US. There's plenty out there. We just need to look in particular areas.
Of course there are.
And sorry, Safta, if you want to sort of interrupt and maybe go on, would you agree with the point around like China, for example? Would you see there's an opportunity in China?
I mean, obviously for us, as allocators, investors, we've been in China for a few years now, allocating directly into a China allocation, as well as EM overall. It's worked for some years, certainly more laterally it hasn't worked. But certainly if you look at recent Chinese GDP growth, which was still fairly robust, if you look at the view that Chinese interference by the state could be over in terms of their interference there. So that should be, and valuations are still fairly normal, should be fairly positive for China. But the point I would make on your question, Sam, is just going back to what we do at Value Capital. So what we're trying to do, we're trying to find the best companies through funds or strategies in the world to invest in. There's 100,000, I'm sure we'll touch on it in the presentation, but there's roughly about 100,000 equities out there. We want to try and capture the best 1,000 or even below that in the world. And as Hussein's articulated as well, many of the best companies reside in the US. So despite the fact that the US has done, I don't know, 10, 15 years of strong economic growth and capital returns, it's very hard to bet against that in light of what we're seeing in terms of some of the sectors or themes, healthcare, technology, we just touched on as well, in terms of growth, the opportunity set that they could disrupt, not now, but going forward as well. But in saying all of that, something that we are thinking about by Lead Capital is the US, is whether EM is interesting. We like EM, so that's fine. India's going through an election. I think that should be fairly bullish for Indian equities post-election imminently. But I think a view that we're trying to understand is whether the UK bear market is over, and UK is now in more of a kind of bullish growth phase in terms of the stock market. On valuation grounds, corporate M&A momentum picked up as well, end of Q1, now into Q2. So we're trying to understand that, and we won't obviously know that until things have changed going forward. But it seems to be the case that we could be in a UK growth phase, certainly in terms of stocks anyway, which is interesting because obviously we've not had that dynamic for a while. And it's interesting in terms of our peer group, the way that's behaved, which is a bit of a contradiction at the very time that we're going to get probably a change of government and a change of cycle from Conservative to Labour in the summer, that we're going to see a pickup in the UK stock market. A contradiction, irony, you can argue. And
on that point, I think it's on everyone's minds. For 2024, we have the UK election. We also have the US election coming up towards the end of the year. How do you think that these election results will affect global markets, whether that be in EM or whether that be in the US or even the UK? Shane, do you want to sort of elaborate on that?
Yeah, I mean, the general point I'd like to make about both of those elections is the fact that these governments are constrained. They're constrained on fiscal policy essentially because of what's happened after COVID, with debt being much higher and also essentially deficits being much, much higher as well. So it's not like, whoever comes in can suddenly announce a big package of spending or tax cuts. And we know how markets have reacted to any big outsized policy pledges or announcements. It's not been pretty, right? We saw that, fairly recently in the UK. So that's really, for me, a really important kind of macro consideration. These guys are not going to be able to shift the dial much on fiscal policy. But I mean, specifically on the UK, that fiscal policy thing is not everything. There's also this idea that perhaps a new government, assuming it has a big enough majority, can perhaps create an environment which is more stable, predictable in terms of policy making, which could be good news for UK investors, or just generally investors globally and their appetite for UK assets, which I think there is evidence out there to suggest has been affected by Brexit, for example. So if, for example, Labour come in and engineer a slightly closer working relationship with the EU, that could be perceived as a positive for global investors. And also, I think there is maybe some uncertainty around the impact of Labour on workers' rights, could be seen as a negative in terms of company profitability if they start giving unions more power or raise the minimum wage, for example. But at the same time, anything which helps workers on the flip side could boost consumption and consumer power. So it's a bit of a mixed picture, but broadly, I would say there's not much these governments can really do in terms of shifting the dial. So not expecting it to be a major event for investors this year in the UK. On the US, the fiscal arguments apply. as I've just laid out. But you do need to think about what, Trump, for example, if he comes in, what he could do in terms of foreign policy and how that affects the kind of confidence in terms of risk appetite. Certainly you'd expect a bit of a ramp up in trade tensions, specifically with China. He's threatened a blanket tariff of 10% on all goods coming in, 60% on China. All of this stuff would potentially rattle markets if he's able to do it. But again, some uncertainty about his ability to do that without congressional approval. And it could be kind of just rhetoric ahead of the election. We're not quite sure. It's not like the Democrats have been dovish on China as well. So
his job is to stir the audience, isn't it?
Yeah, and
as many see.
It works for him, right? So his voter base likes to hear this protectionist rhetoric. But if it's implemented, it's going to have some effect on the economy. But given that, there's been a ramp up in tariffs now in place for years, I wouldn't expect the shock to markets or the shock to the economy to be as large as what we saw back in 2017, 2018, when those first rounds of tariffs were coming through. So again, I'm not expecting it to be too damaging or impactful on markets overall. Personally.
Yeah. No, good point. And Safta, have you got anything to add to that?
Yeah, I'm pretty much similar view to Hussein in the main. I think the election, where it's the UK election, the US election, won't have any impact. Certainly might have impact on markets. What really have impact on us as investors? Again, going back to the point about being very long term, taking a 5 to 10 year view instead of an asset allocation, thematic views. Whether Trump or Biden or Labour and Conservative shifts won't really move the dial for us. The only thing I would say for Trump is, or certainly the US election, has got implications for, as Hussein again highlighted, foreign policy, geopolitics, whether that's against Ukraine and even the Middle East, what we're seeing now. And again, context around oil, commodities and so on as well. Inflation may reappear if there's a hawkish view there. So things like that we need to just bear in mind. But certainly in terms of investment thinking, long term, it won't change our thinking whatsoever. We're already kind of positioning well ahead of any election outcomes whatsoever, where, as I mentioned, even India, South Africa's got elections as well, and so on.
Brilliant. I don't think it would be an investment webinar without talking about AI. I think it's an important topic to discuss. It'd be interesting to hear both of your views on AI and where we will be by the end of the year, or perhaps your 3 to 5 year view. Do you feel like it should be part of an investment portfolio? And if it's not, where are the other opportunities, if so? Do you want to take the lead?
Yeah, it's a big deal, undoubtedly. I mean, this is comparable probably to the rollout of computers, the mass rollout of computers back in the 90s in terms of its impact on economy-wide productivity, but also just company efficiency. So, labor productivity and firms are going to be able to capitalize on how this basically saves people time. And it's clearly been a predominant driver of markets over the last 18 months. We've seen what the US tech companies have done since kind of early last year. It's not all been about AI. I mean, it's also been a recovery trade following the big drawdown in 2022. So let's not forget, 2022 was an awful year in markets. Tech shed a huge amount of value. So some people have just been, it's all about AI, but forgetting its recovery as well.
Of course.
But nonetheless, I mean, it's a big deal. And investors also impatient. So they've latched onto this theme and they see potential, and they're just essentially trying to capture all the long-term gains. Because this is a long-term thing. This is going to be over the next 10 to 20 years. This is not a 1 or 2 year story. But clearly, investors want to get on the bandwagon, buy up anything which is AI related to make sure they don't miss out.
Yeah.
And that has pushed now, valuations amongst some of the AI predominant names in the market to quite stretched levels. You look at PE ratios amongst, the big Magnificent Seven names, they're all now kind of in the 30s and above, which is high. But, at the end of the day, these companies, unlike in the late 90s with .com, they're huge, they're generating profits, and, they're proving they can make money out of this already. And it'll probably get even more profitable as we go on. But what makes me worry slightly is not everyone's going to win from AI. Some names, for example, in the 90s, which surged. I won't name any individual stocks, but there were companies back then, infrastructure providers, telecoms, and so on, which had their moment in the sun. And then, you got into the early noughties, fizzled out, and some of these names, which had capitalizations in the billions, are now no longer existing. So we need to be a bit careful that, not everyone is going to be winning for the long term. And what also makes me nervous is that kind of 90s bull market in stocks, which a lot of it was .com, tech, PCs, wasn't just about that. There was also a macro regime in the 90s, which allowed stocks year after year from 1995 onwards, essentially a 5-6 year bull market, to be successful. And that was interest rates coming down, central banks getting their independence, that 2% inflation targeting regime being introduced. So that stabilization in the macro, that lower inflation, lower interest rate regime was really important. We're not in that environment now. Rates are higher, macro volatility is quite high. We're not expecting rates to crash back down to zero anytime soon. And also, I think, Safdar mentioned the geopolitical risks. They weren't really as elevated back in the 90s as they are now. You look at most indicators of geopolitical risks, they're quite high for obvious reasons. We know what's going on in the world. That's not a great environment for risk. That does imply more volatility politically, but also that can bleed into commodity prices. It can bleed into supply chain disruptions, and that is not brilliant for companies operating globally. And because US multinationals are such worldwide operations, that disruption is potentially
having to manage those geopolitical risks.
Yeah, it's a problem. It's a problem, and it can be. I mean, in our view, that is actually a structural source of inflation in the economic system. Inflation is not good for stocks at the end of the day. It depresses multiples. It creates more kind of macro volatility, the risk of recessions becoming more frequent. It's not the 90s, basically. That was hyperglobalization, China essentially being embedded into the global economy, prices coming down. It was brilliant. It was a brilliant time to be a stock investor. So even though in the near term, the US market continued to roar ahead, we're not expecting anything to disrupt this really good US story in near term. It's just difficult to argue for like multi-year 10-15% a year gains.
Understand.
Valuations are stretched, and there's a lot out there in the macro regime, inflation, geopolitics, rates, which kind of make it a bit of a struggle to kind of sustain these really strong numbers.
Great. And Safdar, do you have anything to add?
What would add there is pretty much concur with what Hussein is saying. What I would add there is a couple of points. I think it was Bill Gates that said people overestimate the short term and then underestimate the long term. I think that could be elements of what's happening with AI now, where still very early days. We're literally a year, 18 months into it, albeit we are buying capital, been talking about some of this kind of stuff in terms of some of our tech thematic allocations for a while now. It's unclear who the winners will be, but it's also quite clear what the possibilities are, certainly in terms of some of the share price growth we've seen, unlike the .com, which I also witnessed through as well. some generally world-class companies with profits, strong moats in what you're trying to do. And I think the opportunity for AI or technology generally, whether it's AI, the metaverse and other kind of themes coming through, is probably underestimated long term. Certainly around really transformative healthcare, biotechnology, personalized medicine, which as we know, governments are now grappling with the longevity and healthcare issues that everybody has globally. So I think that's going to be transformative. Again, it's about finding those winners and who will win. And it goes back to the point I made earlier about out of that stock, global stock universe, is trying to identify those key winners that we want to invest into directly or through funds that will capture those kind of returns. And that is very hard and still to be determined. Clearly, we've had a good year in terms of allocating into that, and that's a positive. Things could change very, very quickly. And the only other thing I would add to that as well, where is the smart money potentially going? We saw even this week, Elon Musk's AI startup, I think it's XAI, raising $6 billion through some pretty savvy investors in the US, Europe, and the Middle East. So obviously, a lot of people are investing a lot into this, and there are going to be tremendous opportunities. We just got to navigate that well in the context of the risks that we know, global risks, corporate risks, inflation risks that Hussein's articulated. And for us as long-term investors, certainly it's a theme that we'll probably be seeing increasing in our portfolios rather than less so, increasingly being dominant in some of our allocations, certainly in the US being one example.
Amazing. No, really good points. I think we'll go on to one final question, just to make it fairly brief. Views on interest rate cuts. When are they going to happen? US, UK, what's your both views?
Yeah, I mean,
I don't need a date, I just need an approximation.
Yeah. No, I mean, this is really important. Market's been all over the place, right? So January, you look at the market pricing, what was embedded in futures, 7 cuts for the year. Where are we now? I mean, markets barely got 2 in the price. It's splitting between 1 and 2. Personally, I think for the US, it's going to be difficult, I think, for them to do anything this year. The market's kind of got in its mind September, but not really. It's not fully priced in. And I think that's about right, given just where the data is, to be honest with you. I mean, the economy is just still too strong, essentially, bottom line. And the problem is services, right? And a lot of that is essentially a function and a derivative of what's going on in the labour market. And we're seeing cooling. We are having a labour market that's slowing down, which is good for the Fed. They want that, but just not quite quickly enough, I think, for their comfort. So because of that, I think there's a good chance they'll delay until early next year, which is not far off market pricing. It's barely 1 to 2 in the price. I think for Europe, it's a bit different. The economy has always been a bit weaker there. We've had a big disinflationary process come from energy prices. Yeah. So the tariffs have come down following the Ukraine shock. So for the Eurozone, it's essentially a done deal for next month, early next month.
Is it next week? Is it?
You're right. It's next week. Yeah. Yes, next Thursday. So that's a done deal. The ECB is going to cut. They've telegraphed that now for a while. Bank of England not going to do it because of the latest batch of inflation data, but I still think there's a good chance they go in later in the summer, simply because inflation's now pretty close to target. They've had some really good news on the good side of the economy, energy prices, gas, and so on. Just still, I think what's kind of keeping them away from the imminent cut is essentially similar to the US. The strength of the labour market is keeping that services inflation a bit too high for comfort. So they'll go after the ECB and before the Fed.
Yeah.
Yes, is my view.
Okay. And Safdar, if you could.
Again, briefly, I think again we're not economists here or strategists at all. So it's hard to say beyond. Firstly, to some extent, we don't really care whether they cut or they don't cut because we want to try and again invest through that. But if I was to kind of make a call on it, ECB, Bank of England, and the US in that order, probably this year, maybe 1 or 2 cuts for both. I believe, but again, as Hussein said, it's been all over the place. Who knows? People were expecting a cut by now in the US. Clearly, it's not happened yet. Very strong economy, inflation being sticky. Appears to be elements of that last mile being very difficult. My personal view, is that inflation will eventually undershoot. So that should be interesting how that happens, the dynamics of that, if that happens as well. But in summary, we don't really pay too much attention to it. We manage through it, we invest through it, and we allocate. We don't strategically allocate based on an interest rate view at all. But we'll see what happens.
Yeah, not really.
But is that one point?
Sure.
It's actually really in agreement with Safdar about that point. It doesn't really matter to us. I think that was a interesting comment because I completely agree. As a bond investor, especially right now, given where yields are, you're loving interest rates at these current levels.
Yes.
So if they don't cut, it's not a problem.
Yeah.
You can still harvest those yields, and you're doing well. But if they do, and especially if they do more than what's in the currently priced in, then you're also winning.
Yeah.
So I mean, it's kind of like right now. We're saying put cash to work. It really makes sense for us. Put cash to work in bonds because you've got these yields which are high by recent historical standards. You've got corporate bonds where you're getting extra kind of carry from the credit risk component, which is great. With a default outlook which isn't that bad, especially for investment grade. I mean, a lot of these companies are sitting on really strong balance sheets. So, I mean, the risk of default amongst the big names is still low. But then, in that scenario of disinflation or a surprise downturn or leg lower in inflation, and central banks suddenly find an opportunity to do more, then the capital gains in those asset classes could be enormous. They could be enormous. So, for us, it's a real winner right now.
Sure.
To be invested in that kind of part of the high quality space.
Yeah.
In the bond market.
Finding the value. Okay, brilliant, chaps. Thank you very much. That is the end of our panel discussion, and thank you, Safdar, very much for that. Some really great points, and I hope everyone was listening. We're going to sort of move on now to the next part of the webinar, where Safdar, you're going to sort of take over and discuss a little bit more on binary and what we've been up to, our approach, our thoughts for over the next 6 months, or definitely over the longer term. So I'm going to hand it over to you, Sam.
Yeah, thanks, Sam. Yeah, try and keep it brief, conscious of time, and we want to do some Q&A hopefully at the end as well. As many of you know that are online, and then some that don't, and kind of some of the stuff that kind of already articulated in the kind of Q&A, we're long-term thematic investors. We are very much around themes globally, around in terms of some of our portfolios that we manage. If you think about it, and I use this example a lot, the average DFM in the UK will have 20, 25 plus positions in a portfolio, a balanced mandate, for example. We have 10 to 12, maybe 14. So we know what we like, and we stick to that. And we stick to that long term. We have about 10% or so portfolio turnover, one in, one out kind of thing. Once a year, we have a strategic review balance every 6 months. We're about to do that next month. And again, I'll probably touch on that in the coming slides. But so it's part about high conviction, selective investing, getting those 1,000 or 500 best investment ideas out there and investing in them. senior active ethical portfolios and not deviating from that. We're not index trackers, we're not index huggers, we're not closet index managers, so we don't do that. And that's all we do. We're focused, we're independent. We're here with kindly with HSBC, so we use some of their products, but we use other products as well across the range. We don't have any in-house binary products, so we've got no conflict of interest whatsoever. We talk around and think around themes, again, the themes that I've already touched on, and that's embedded in everything that we do as well. And that's what differentiates us from the competitors. We like to think in a good way, strategically, as well as from a risk and performance basis, whether it's this year, last year, even longer term, in the 5-6 years, we've been managing money there. Sure. So one thing I want to touch on here briefly is going back to the point about being long-term thematic investors, and going back to the point about being high conviction and not similar to our peer group. One thing that we do is in a kind of balanced mandate. It's not just your typical 60-40 fixed income equity split. We've got an allocation to absolute return strategies, genuine absolute return strategies that we've been researching for many years. We've invested in for a few years now. Okay, so that's interesting. That gives us two things. In any market drawdown, it gives us elements of capital protection and growth often as well. Okay, and as markets move up, as they've done in most months, certainly this year and last year, we then still get that capital protection, but it means that we can take a bit more risk, a bit more leverage, or a bit more of that kind of growth bias that we have in our portfolios, in our US allocation, for example, in EM or China, that ordinarily the other managers or asset allocators perhaps wouldn't do. And it gives us quite a bit of a kind of win-win situation that way, in terms of markets are doing well, we'll produce pretty steady above market trend returns. And if there's a drawdown, we should be able to, in some elements, protect that capital. So it's an asset class that many talk about. Clearly, there's a lot of risks around it, but we tend to look at very vanilla, long-term, again, transparent, genuine absolute return funds out there that will go across, whether it's fixed income, commodities, the equity space, and research them and then bring them together. And again, we're actually looking at something very interesting that we may even add to this asset class as well. And we don't take this view as a small position. We've got as much as 15, 16% in some of our mandates in this allocation. So don't see us as a traditional equity fixed income house. It's very much kind of three-pronged pillar approach to investing, fixed income, equities, as well as absolute return, which combines all of that together and doing that. And it gives us flexibility, gives us, we believe, stability of return, transparency of return as well, and extra alpha that perhaps other competitors can't do. And we kind of demonstrated that in some of our return generation over time as well. This kind of just summarizes graphically what I'm kind of talking about somewhat. It could be a bit of a complicated chart, but if you focus in the middle box, because what we're looking to do potentially is change or reallocate, and we've done this historically, some of our fixed income allocation, to take that 40% as an example, into absolute return, okay, to give us fixed income like returns without that risk. And if you do more of that in some of our funds that we're looking at, whether it's a trend following fund, whether it's some of the absolute return funds that we like, Fulcrum, CG, as well as Troy. And if we do that, if we add to that, what that middle box demonstrates is you get lower return, so you get lower risk, so the risk goes down, but you get a far higher return in your overall portfolio in terms of that fixed income towards absolute return allocation. That kind of orange box arrow going up to that reg box, and that's over 3 years. And you can look at the more short term as well as even longer term. There's actually a material difference as you allocate away from fixed income towards some, not all, but certainly some interesting absolute return mandates that are out there. So the question one asks is, why would you not want to do that? If you can lower the risk, enhance the return, get a better Sharpe ratio, so get a better return for the risk that you manage in doing so, why would you not want to partake in that strategy? So it's something that we've already done for the last 2-3 years, and we're potentially going to add to that allocation as well, bearing in mind some of the stuff we talked about earlier. Some valuations are high, growth might do well in Western economies, certainly in the US, but there's elements that could be pullbacks, and we don't want to get carried away in some of our allocations. So we want to still manage the risk in terms of some of our growth buckets, but in a controlled way, but we're still with hopefully good return generation, good alpha generation as well. So this kind of chart demonstrates that pictorially there.
Sure. Moving on.
Yeah, next slide, Sam. Again, very similar concept I'm discussing in terms of managing, focus on the red line in terms of your typical 60-40 portfolio, in terms of drawdowns one has experienced historically, against the blue line, which is potentially a more 50% equities, 30% fixed income, and 20% absolute return, balanced mandate, for example, as well as your absolute return bucket in the red line. Notice how much more stable it is, much more less of a drawdown one would face in that scenario against your fixed income, as we know was at a challenging time, certainly in 2022, or against even your typical 60-40 portfolio, which is in the black line, how it has had a deeper drawdown and more volatile than your other portfolios. And go back to the point I made earlier, if you can stop that volatility or certainly decrease it in terms of that risk, but still enhance that return, maintain that or enhance that return, it seems to be a very compelling allocation to make. And again, it's something that we believe differentiates from many of our competitors who either don't do this or still are of the kind of historical old school mindset about fixed income and equities. They may have some absolute return, they might have some hedge funds or other strategies, but typically when we've had a look at that, because we do a lot of comparisons, clearly when we look at mandates, it's been very de minimis. It's been 3%, 5%, maybe 10% maximum. But because of our conviction-led approach, we're happy to go as much as 15 to 20% in that kind of asset class or that strategy to maintain that kind of risk and return kind of payoff or trend that we want to see in our portfolios. So again, very different from what's out there, we think, in a good way. And again, as I said, the numbers are the numbers, have demonstrated that somewhat, certainly more recently. So this slide's about, okay, so I talked about absolute return. So that then, it's almost like an insurance policy, absolute return, our absolute return bucket, because it then gives us the flexibility, the freedom to talk about some of the things we've already discussed in terms of technology, healthcare, US, the EI themes that are coming around this year for the rest of this decade, even beyond that, and actually use them in our strategy to within a very high conviction way to generate those returns. As I said, if the US market is up, we outperform that typically. When global equities are up, we do well as well in that respect. And it gives us that kind of flexibility, that kind of added leverage in our returns that other people can't do, or they diversify that away with other suboptimal strategies, and they end up like very much like index-like approach or index plus approach, which we don't really believe in. And it gives us, I talked about symmetrical return payoffs, and it gives us that, i.e. we manage the downside or protect the downside as much as one can. Markets are down 2%, we might be down 1.5% or so, or similar to the market. Won't be like -4, -5. Markets are up 5%. We're up 5.5 or 6% as kind of examples, and it kind of manage that that way. And we also think about, in the short term, they may well be pulled back, pushed back, resets, call it what you want, but we don't really mind that. It's all about very long-term investing, very much aligned to the advisors and deadline clients who themselves should be long-term in their thinking. And I just kind of reference that quote at the bottom, which kind of speaks for itself in the way we think. We believe, and it's, again, we talk about this a lot when we speak to clients, is where the best investors in the world, whether that's in the UK, Europe, US, have got this kind of thinking underpinning everything they do. High conviction, long term, low turnover, being very patient with the capital and investing. If things change, they change or they maneuver. But beyond that, they don't touch their portfolios too much based on 1 month, 3 months market trends and movements that can often be, as we know, random movements or very idiosyncratic that may not be long-term thinking whatsoever.
Sure. Thanks, Jeff. Right. Do you want to speak on this a touch? Could we go conscious of time, that's all?
Yeah, in terms of timing, I kind of touched on this slide before. Kind of typical asset allocation. We've got things to highlight there is really a 16% absolute return allocation that I've already talked around, and that may increase. So watch this space around it. We'll articulate that as and when that happens. And the other thing I would highlight here is that we've got a large allocation to the US in part of our equity allocation, as much as 50% plus as part of our kind of equity allocation. We don't really use cash strategically either, so cash is kept de minimis in any portfolio whatsoever. And again, a kind of chart that really kind of gives our style basis where we are liquid investors. We're mainly large cap investors with that kind of growth bias in that kind of top right box in that kind of quadrant. So we're not deep growth, we're not blended, albeit we are kind of moving into that space, but we've certainly got that bias towards growth. So typically our portfolios, if you want to look at it come from an exit basis, would be about 40%, 40 to maybe 50% kind of growth category, 30% blended equity component, and maybe 20% value. And so that's how one should see us in terms of our kind of equity bucket as well, which is a little bit more than the benchmark or the index. And we're quite happy with that positioning, again, for reasons that I've highlighted in terms of some of the risks off that we can do in our absolute return allocation as well.
Sure.
Again, I don't want to dwell on this slide, but it's very interesting for us. So focus on the kind of blue, the kind of various shades of blue for a minute, if you can. Basically, it's telling us in our kind of active or passive strategies for last 1 year and 2 years, comparing against one of the leading providers out there with respect to HSBC as well, Vanguard, who have got some really compelling strategies. Compared to them and against the kind of IA sector, we have moved from right to left across that scale over that period, which is again demonstrating we're taking less risk, slightly less risk, but creating better return outcomes for clients. So again, making the point again about the risk management is very, very solid, clear and transparent, as well as that you still get a good or positive and compelling return outcome for each strategy, whether it's defensive across to adventurous as well. And again, as I said, comparing it to Vanguard around that quadrant or around their portfolios where we move in the right direction against that. Clearly, if it was the other way around, we would have a concern. But certainly in terms of what we're trying to do, we seem to be doing the right thing for the clients in the right way, i.e. managing the risk as well as managing solid return outcomes in that context.
Amazing. Okay, well, thank you for that, Safta. That was really interesting, and I hope everyone could sort of get an understanding of where we are in terms of risk management, our views on absolute return, and certainly on performance. But if you do want to find out more about the solutions and how we're trying to improve them and work with financial advisors, then please reach out to anyone at the sales team. Just really briefly from me, we've been working super hard over the last sort of 3-4 months on a sort of binary capital 2.0, as you will. New website, new design, new logo, new everything. Marketing material, we've completely chopped and changed everything, and we're really proud to say that we've finally got to the stage where we can release it to the wider market, and we're really proud of the work we've done. So if you do get a minute today, please check out our brand new website. We've got a brand new portal as well, where advisors can log in, create a username and a password, have access to all our marketing materials, and other features that we're incorporating throughout the year. So really exciting. And then briefly as well, we've actually released to the UK advisory market as well our brand new partnership portfolios. I'm sorry if this is quite boring for some people, but it's our white labeled model portfolio service for advisors who would like to potentially change up their CIPs at the moment, and work directly with an investment manager to build out their own solutions, whether they be involved in meetings with investment managers, whether they come to and discuss in terms of fund allocation, where they would prefer assets to be, all their marketing material within all their documents, where they want to have weekly or monthly meetings with the CIO, the portfolio manager, with completely bespoke, made for your firm, under and powered by Binary Capital, and we're really proud to push that out to the advisory market. So again, reach out to anyone from the team if you would like to find out more. But I'm conscious that we've only got a few minutes, so we're going to go through a few questions now. So if you do have any questions, please pop them over now. I do have some set ones ready for today, but it would be really cool if we could hear from both of you, if that's all right. So I think the first question that sort of came from the discussions that we've had today is opportunity. That's definitely the biggest topic. And we spoke about the US, the UK, and Europe. But specifically for you, Safta, sorry, Hussein, I'll come to you in just a moment. But specifically for you, in terms of model portfolio solutions, are you seeing a shift in the wider market of where they're now allocating assets in terms of the portfolios you're seeing?
I think it's interesting, Sam. What we saw, I mean, I think you know yourself. Say 2-3 years ago, when we were doing comparisons with our competitors, there was very much a kind of UK home bias. So that was an easy win. We knew that we weren't UK focused, so we could say, look, we're not UK focused. We don't have that home bias. We don't have that psychological focus on the UK. This is what we do differently. This is why you should consider us as a kind of global investor base. What I've seen over the last year or so is that trend shifting. Less of a UK bias. GFMs, our competitors, whoever, have woken up to the fact, hang on a minute, there's other investment trends out there that one should be following and giving up in the UK, which is interesting. It's counterintuitive from the point I made earlier. At the very time the UK may pop up long term, not just this year because of Labour or whatever, long term in terms of some of the corporate activity and valuations, if nothing else, that are out there. So I think I've seen that trend, and that's why the UK is getting me or getting us excited as well, potentially as an allocation tool. More of an allocation going forward. That's certainly one of the trends that I've seen. And going back to your point again, you know, a lot of advisors now beginning to subcontract because of the complications of just managing money now because of the variations of markets, trends. I'm sure Hussein sees that as well in terms of needing expert advice more regularly and more consistently.
I think as MPS solutions or DFM providers, we see a lot of noise in the market, and it's all about trying to make it as easy and simple for advisors to understand where their clients' assets are being invested into. Without not trying to reinvent the wheel or anything like that.
Exactly. I mean, we all overcomplicate finance or investments, but as I said, if you look at the best thinking of investments or people out there, and that hasn't changed for generations. Be focused, have high conviction. If things change, by all means change. Look at it long term, because we don't typically have short term insight at all and what's going on, and manage through any of the downturn and so on. We obviously had a small drawdown in 2022. We could have changed and de-risked that, but then we would have missed out on the 2023 upside, and even this year as well. So you got to see through that and not panic and be focused mentally with that kind of mindset.
Amazing. And saying this, something you said earlier that really stuck with me, and I think I want to sort of develop on some of your points you made. We've spoken about equities, fixed income. What's your view on commodities, property, in terms of from a HSBC perspective? Have you got any sort of specific
we don't take strong positions in commodities in the portfolios, but we do recognise them as, interesting. What we like to say is ballast in the portfolios. I mean, given where inflation has settled and the uncertainty around that, there is some evidence to suggest they could be acting as an inflation hedge. So that's an interesting theme for us. Gold has been really
popular asset class.
Crazy, basically.
Had
an amazing 3-4 year run now. Doesn't seem to be affected by where real interest rates are. That traditional relationship between rates and gold is essentially broken down. So again, really interesting potential diversification opportunities in some of these asset classes in the commodity space, which could continue in this environment of structurally higher inflation and geopolitical uncertainty. And I think a world of more like supply side shocks, commodities are interesting. That's for sure.
I understand.
Real estate, sorry, you asked about real estate. I mean, real estate's had a tough time, obviously, because of rates. It's a highly interest rate sensitive market. But again, for us, we are still positive given where some of the kind of index valuations have moved to. So net asset values in the real estate sector have essentially crashed. So you're getting, really good opportunities there to take advantage of any kind of structural or even cyclical rebound in the market. Probably does require, though, rates to come down. I think in the near term, the market's going to struggle for sure.
And I think we wanted to talk about this from a sort of MPS perspective. What's your view on the sort of ESG criteria with what the FCA are coming out in terms of sustainable labels?
Obviously the regulator is cracking down now on the whole kind of greenwashing, ESG, and other metrics, and there's been examples of that certainly in the media and so on. I think certainly some of the, which is interesting. I think again it gives us an angle or an edge, and in the sense of where we generally look at very granular data on the underlying stock positions, the funds in themselves, as well as when they combine together for genuine and ESG ethical portfolio management. Sam, we spend a lot of time doing that, whether that's through Bloomberg, Morningstar, external data sources. HSBC do some great work in this space as well. Clearly on the ethical, Sharia and else space. So again, it should give us an angle, it should give us an edge from some of the stuff I've already talked about as well, to add value basically for the DFM MPS market space.
Which is indeed a very sort of busy area now, isn't it, in terms of the market, in terms of MPS solutions. Everyone's coming out with different MPS solutions, different objectives and criteria of those solutions. I think what we are trying to do at Barney Capital is, like I said earlier, to very much simplify the market. We are in a very tricky space, but hopefully performance upholds, and we have a great year.
As we did last year. But we're very proud of what we've done, quite rightly. But
Sure. Well, I am conscious of time. I know we're only a minute past 12, but unless you guys have any other sort of further points you would like to make.
No, I'm very happy, delighted to help anybody out there. We're always here, open door. I am, Sam is, his team are great to work in partnership with HSBC. So world-class asset management company. Great job, Hussein.
Yeah, thank you very much, Hussein, for coming today.
My
This morning,
pleasure.
Hussein,
My
we
pleasure.
appreciate your
Yeah,
time.
good.
Thank you. Yes.
No, wonderful. Thank you all for coming today. I will be, obviously, you can reach me or anyone of the Binary Capital team. If you would like a recording of this or any of your colleagues, please let me know. I can also send CPD certificates to anyone that's joined today. But again, I really appreciate your time. I get it's half term and you've got very busy diaries, but I've had a wonderful morning and now we're going to have some lunch and relax. But thank you very much, and we'll see you soon.